Ladies and gentlemen, a very good morning to you. We are representing Sunway University and we are here to present our findings on Sunway REIT. I'm Jiawen and I'll be starting off our presentation this morning. We have conducted our presentation in the following order, similar to our analyst report. Based on our findings, we have issued a buy recommendation with a target share price of RM 1.56, a 20% upside potential as compared to the current share price on 21st February 2014. There are 4 key drivers that justify our buy recommendation. Number 1, sustainable organic growth, vital for Malaysian REITs to survive in this current environment. Number 2, positive rental reversion, as can be seen by Sunway REIT's track record 3 years since their listing. Number 3, expected growth from Sunway Putra Place. Located in Kuala Lumpur, Sunway Putra Place has been closed as they are undergoing a major asset renovation and refurbishment. It is due to be reopened in early 2015. Despite this closure, Sunway REIT has been able to maintain a stable financial position, as we can see in their financial results 2013. Now, what is Sunway REIT? Sunway Real Estate Investment Trust is managed by Sunway REIT Management Sdn Bhd, a subsidiary of a giant conglomerate, Sunway Bhd. The investment objective of Sunway REIT is to provide unit holders, their shareholders, exposure to a diversified asset portfolio. As we can see in the revenue in this pie chart, the revenue breakdown of Q2 2014, we can see that 63% of the revenue comes from the retail sector, 23% from offices, 9% hotel, 6% others. This 6% is revenue attributable to Sunway Medical Centre, the most recent acquisition made by Sunway REIT on 31st December 2012. We can see that Sunway REIT is a retail-focused yet diversified REIT. I will now pass on to my teammate Hui Mei, who will explain to us the industry Sunway REIT is managing in. Thank you.
Thank you, Jiawen. Hi, I'm Hui Mei and I'll present our findings on the industry overview. Kuala Lumpur has been ranked the second best shopping destination in Asia Pacific by the latest Globe Shopper Index. Furthermore, the unemployment rate of Malaysia is below 3% and the household income growth has been 7.2% per annum since 2009. As a result, this has increased consumer confidence and made the retail market grow. Office stock in Petaling Jaya and Subang Jaya has been increasing in recent years. This has resulted in a declining occupancy rate in certain key areas. As you can see from the graph, as a result, the rental rates are expected to remain flat in the near future. Based on the table, we can see that tourist arrival and receipts has been increasing since year 2010 and to 2012. As a result, this past trend is expected to continue, especially in line with Visit Malaysia 2014. Organic growth plays an important role in the distribution per unit of a company. It is especially important as it is tougher to find yield accretive asset in recent years. This is advantageous for existing REITs as they have a strong management team who are experienced. As we can see from the graph, comparative yield of a REIT company is still much higher compared to a 10-year secured 30 Malaysian government bond and a fixed deposit rate. Thus, investors would still invest in REITs. Sunway REIT has a competitive position due to many factors. One of it is that they have a supportive sponsor, rental reversion rate. Sunway REIT has a sustainable organic growth, which is vital to their survival in the REIT industry. Out of 12 properties owned by Sunway REIT, 5 of them are situated in Sunway Resort City, a vibrant and comprehensive township. This would have a spillover effect which would effectively allow each property to earn much more than if they were situated alone somewhere else. And now I'll pass on to Wilson on elaboration of valuation.
Thank you, Hui Mei. In our valuations, we have derived a target share price of RM 1.56, and this is an upside potential of around 20% compared to recent share prices. we have based our valuations on two models, which is the DCF models and also the DDM model. Among the assumptions used in our DCF models are a weighted average cost of capital of 8% is used, with the cost of equity calculated using a capital asset pricing model as 9.85% and the cost of debt calculated as 3.85%. The revenue forecasts for the retail and office sector are based on the average occupancy rate, the expected rental reversion in future, as well as the rental rate per net lettable area, whereas the revenue forecasts for the hotel sector are based on the master leases. This is a revenue breakdown of each segment from the year 2011 to 2016 forecast. As you can see, there's a steady increase in revenue on a yearly basis. Based on all these assumptions, we have originally derived target share price of RM 1.81. However, we do not think that RM 1.81 would be a realistic target share price that will be traded in the market. Reasons being, using our forecasted distribution per unit of 8.4 cents in future, we have obtained a dividend yield of 4.6%, in which it is close to the yield from a Malaysian government bond or even a corporate bond. Investors would then shy away from REITs, as REITs are riskier. In this case, we have determined a dividend yield of 5.4% to be a dividend yield level that is acceptable to investors. And factoring in our distribution per unit of 8.4 cents, we have derived with a new target share price of RM 1.56. However, there lie several risks in our intrinsic share price, with revenue and the future growth rate affecting the most and property operating costs having minimal impact on the intrinsic share price. Any fall in the intrinsic share price would definitely impair investor confidence and will cause our target share price to drop even further. The second model that we have adopted is actually the dividend discount model, in which we have derived a target share price of RM 1.61. However, we prefer to be more prudent in our valuations and stick to RM 1.56 that I've mentioned earlier as our target share price. As a result, the dividend discount model will only be used as a reference only. Thank you, and I'd like now to pass to my teammate, Yuan.
Thank you, Wilson. I'm Yuan, and I'll continue from peer comparison. Sunway REIT has outperformed its competitor. The competitor used for this purpose was IGB REIT due to their similar asset size and market capitalization. Sunway REIT is a preferred investment for future investors because, based on the following table, as seen in the highlighted areas, which are the distribution per unit and dividend yield, Sunway REIT has surpassed the performance of IGB REIT significantly. Next, we'll focus on financial analysis. First, in terms of earnings, Sunway REIT has shown an upward trend in its earnings as shown in the graph. The strong earnings growth was mainly due to three reasons. First, being strong rental reversion of 15 to 20% for retail sector alone. Second, asset enhancement initiatives has been continuously undertaken by the management. For example, the refurbishment of Sunway Putra Place. Third, active acquisition has been employed by the management. For example, the acquisition of Sunway Medical Center in order to further diversify its portfolio and thereby spreading the risk. Next, in terms of cash position, based on our forecast, Sunway REIT will be showing a steady increase in operating cash flow. However, for financing and investing cash flow, they will be showing negative results due to refurbishment and substantial distribution. Next, in terms of earning, in terms of gearing level, Sunway REIT has shown an optimal level of 31%. With this optimal gearing level, Sunway REIT will be able to secure future financing opportunities as well as fulfill their refinancing needs. As at the financial year end of 2013, Sunway REIT has RM 315 million of unencumbered assets to secure future borrowings. And lastly, in view of rising interest rate in the future, Sunway REIT has committed to 80 to 20% fixed to floating debts in order to mitigate the adverse effect of rising interest rate. Thank you. Now I'll pass on to Jiawon to elaborate on investment risk.
Thank you, Yuan. As with all investments, there are several risks in investing in Sunway REIT. We have come up with several risks, as you can see on the chart. Number 1, asset renovation and enhancement works. Number 2, interest rate risk. Number 3, financing and refinancing risk. Number 4, Sunway REIT is highly dependable on its sponsor, Sunway Berhad, in direct and indirect means. However, Sunway REIT has been able to mitigate these strategies above. Now, I will pass on to my teammate Wilson to conclude our presentation. Thank you.
Thank you, Jiawon. In conclusion, we strongly recommend a buy decision due to 4 main factors. Number 1, sustainable organic growth in future years. Number 2, positive rental revision expected in future years. Number 3, the upcoming potential from the Sunway Putra Place. And lastly, not to forget, a stable financial position despite the temporary closure of the Sunway Putra Place. Thank you for your time, and I'd like to now open the floor to Q&A sessions.
For an interesting presentation. I just want to ask your rationale. You took DDM again, but you didn't use your DDM value, but you took slightly lower value. And you also had dividend, you had the DCF value, but then after you took the half against the DCF. Just give me a rationale for that.
Thank you for your question. To answer your questions, in our research, we have actually adopted two approaches to this. The first one, we have analyzed the fundamentals of the company, which is reflected in the DCF models, which goes to how the company performed. And when we originally derived a value of RM1.81 from there. However, we also do need to consider and take into account the practical aspects, as in what is the price that we traded in the market in the future. As we know that the price that we traded in the market is not necessarily the intrinsic value of the company. It can be, there can be deviation due to market buying pressure or strong selling pressure. Therefore, in view of this, we have taken into comparison of different yields that investors can invest in. And therefore, in this context, we have determined that a more realistic share price would be IM 1.56 after factoring in the yield that can be obtained by investors. And by adopting these three approaches, which is the DCF approach, DDM approach, and also the practical aspect, which from the investor's perspective, we stick to the more prudent valuation, as we want to be more conservative to minimize our risk, and we set RM 1.56 as our target share price. And by using all these three methods of valuing the company, we can then have a higher level of confidence that the target share price in the future will be more accurate. Thank you.
I still don't know how you arrive at 5.4%. 5.4%, what is the historical premium to your risk rating in terms of REITs?
The 5.4%, which we determine as a dividend yield that is acceptable to investor, is actually the dividend yield as at the year end 2013, which is published in the annual report of the company.
Acceptable, I don't get you. What is acceptable?
Which means that
What's acceptable to you doesn't mean what's acceptable to the rest of the audience here.
right. Which means that from the annual report,
I don't want the annual report. What's your historical premium to your risk rating? Can you tell me that?
we believe that investors would want 1.3, 1.5 something is actually the
If
share price.
your risk-free rate goes up to 4.5%, so what's acceptable to you for a REIT like this?
We think that investors, if the risk-free rate goes up to in this case the Malaysian government bond, 4.11%, and we believe that investors would trade at 5.4% dividend yield, as that is reflected in the historical share price of the company, and we can assume that at that point of time, investors would trade at that price and accept that dividend yield as an acceptable level to them. Thank you.
The other thing is on the rental reversions. You have forecasted quite strong rental reversions. Using historical numbers, or you have that much confidence in your future?
Thank you for your question. We actually base the reversion rates on the past. For the retail sector, the management also forecast a double digit in the future years. Therefore, we decided to take that into account and use that as well. For the office rates, we have derived based on the past for Menard, the Sunway Tower, we can see it's been reducing in the past, so we decided to take a prudent approach and actually maintain that 2% as well. So basically, it's, in conclusion, it's based on the past external reversion rates and expected future.
Have you done any peer comparisons? Your comparables in Klang Valley?
Yes, we compare with IGV rate.
Really? Yours is
Because Sunway rate is a diversified yet retail-focused rate, so it is very difficult to find a fair comparison to Sunway rate. So we decide to follow a similar asset size and market capitalization, which is IGB rate. CMMT and Parallel may be similar in market capitalization, but the asset size is different. So we decide to use IGB rate as comparison.
Can you explain on your master leases and how will it affect your earnings going forward?
Master leases means when the variable rate is lower than the fixed rate in the lease agreement, they will still have to pay the fixed rate.
So when does your master lease end?
Master lease is different for every.
The master lease actually ends 10 years, according to the prospectus of the company.
10 years from now or 10 years when it was listed?
10 years from when it was listed.
So don't you think there's a risk that
There is a risk, but we foresee that in the future, Sunway REIT will be able to mitigate this risk and hopefully renew the master lease with the hotel. So we assume that it will be renewed, and as a result, the master lease will not significantly impact the Sunway REIT's earnings.
Have you done the sensitivity analysis in terms of your price target versus interest rate movements?
We have actually done a sensitivity analysis in our DCF model, which we think is quite fair because any changes in the revenue, property operating costs, or even the future growth rate will eventually affect what is important to most investors, which is the earnings of the company. Therefore, we think that our sensitivity analysis done on the DCF model is a fair approach.